What's up, y'all? It's your boy AP Reese, and in this video, I'm gonna be breaking down what liquidity is, why it matters, how you can better understand it, so you can completely change the way you view the markets. So let's get into it. So liquidity is basically where everybody money is just sitting at, right? So the market knows where people are placing their stop losses, breakout entries, and people is panicking to exit their trades, right? So a lot of time, price will run to these areas right before they make their real move. That's why you see as soon as price go above highs, everybody's trying to buy, then they dump right after. Or sweep lows, make everybody panic sell, then that shit just reverts right after. The market constantly looking for liquidity because that's where the money is. So the market is always going to go to where the money is at. It's just as simple as that. So as y'all can see right here, everybody can see these highs, right? So you got sellers that's trying to sell here and saying this is a double top that's trying to sell in this position right here. And they're likely to put their stop loss right above this high. And then you got breakout traders who's looking to buy. So we got sell stops and buy stops in the market right here. Dudes is ready to sell, dudes is ready to buy. So this means that it's a ton of money that's just sitting right above these highs, right? And for us, we call this external range liquidity. Price starts to go in your favor just a little bit, and then it comes back up. It's getting the sell stops for the guys who try to sell, and then it got the buy stops for the guys who try to buy. So the guys who try to buy is going to get stopped out here on this move because they try to catch a move here, boom, and then the guys that try to sell here is also taking a loss because they're trying to sell, and then price came back and stopped them out there. So you got buyers and you got the sellers that's going to be in the market that's going to be getting stopped out once price come and take external range liquidity, right? So there's two types of liquidity in the market. You got external range liquidity. This is the obvious stuff that everybody can see, the old highs, the old lows, the highs, the equal lows. And then you got the internal range liquidity. It's more of inside the range. So if you have a range here, you're looking for price to come back down to get internal range liquidity to then make its way back to where the market actually wants to go. So that's where your fair value gaps is going to be, your inefficiencies, places price may retrace before continuing back into the right direction that it wants to go. So instead of thinking, I want to buy right now or I want to sell right now, I'm first asking myself, where's price trying to go? You want to ask yourself questions. Where's the money at? Where are traders most likely trapped at? So I built my bias based off of understanding, well, what is liquidity? Let me understand liquidity. And then based off of me understanding liquidity, now I know where the market is going to go. So now you got a directional bias, whereas though now you can be way more profitable. You can win way more trades just by understanding where liquidity is, what is liquidity, and where is it going? You know what I mean? Look, as we can see here, there are a bunch of lows and a bunch of highs here. So you got this high here. Price came into this high, took out these buyers or these people who wanted to sell, stop those out, boom. And then you got these sellers here. Price broke out here, so they're continuing to sell, and price just went against them. So that'll be your external range liquidity. So I'm gonna give you guys an example on external versus internal range liquidity. So in this example right here, we can see that price had created a new swing low, and we just took external range liquidity. So now that we took external range liquidity, we need price to pull back to get internal range liquidity to continue to the downside. So our bias here is we can get price to come back to internal range liquidity, which will be this fair value gap right here. As we let price play, you can see price came back to this fair value gap. And then now we're looking for price to go to external range liquidity right after that. As we can see, price just took external range liquidity. So you want to keep that in mind. You always want to understand that price always has to go to external to internal range liquidity and vice versa. That's the only way that the market is even moving because of liquidity. You know what I mean? So always keep that in mind. Where are we? If we just created a new low, we should be going back to internal range liquidity, right? So as you can see, price came back inside this gap. So once price take out some liquidity to the sell side, I know that we're going to pull back inside this range so we can collect internal range liquidity. And we can see in this example that price had just broke out and took out these highs right here, taking external range liquidity. And now we want to see price pull back inside this entire range here to collect internal range liquidity to then go back to external range liquidity. So we got a fair value gap right here after we broke out, took external range liquidity, and now price is going to want to come back and get internal range liquidity inside this fair value gap. So let's see how it plays out. And as you can see, price came back down, went inside the fair value gap, and then came back out, got external range liquidity again above these highs. And then it's just a repeated cycle over and over again. Price will always pull back, collect internal range liquidity, break out external range, so on and so forth. So hopefully this video gave you a better understanding of what liquidity is and why it matters. In the future videos, I'm going to be breaking down fair value gaps, entries, and how to combine it all together to create your own model so that you can become a profitable trader. It's your boy AP Reese. Make sure you like, comment, subscribe, and I'm out.